I'm Matt Bichard here in Dallas for Nareit's REIT World 2017. Joining me today is John Case. John's the CEO of Realty Income. John, thanks so much for joining us today.
It's good to be here, Matt.
Now, this has already been a busy year for Realty Income. You're on pace to complete about $1.5 billion in acquisitions. Why has now been the right time to be so aggressive on the acquisition front?
Well, $1.5 billion in acquisitions for us is not that aggressive. Over the last few years, we've hit that number several times. And just last year, we completed $1.9 billion in acquisitions. So we're finding really good investment opportunities. We've sourced $24 billion in acquisition opportunities year to date, and we're closing about 4% of those opportunities. So we're being very selective and focusing on quality, and that acquisitions growth is contributing to our 6% earnings per share growth that we're anticipating this year in 2017 as measured by AFFO per share.
The company's portfolio occupancy rate currently exceeds 98%. Do you expect that level to hold up into 2018?
I think it will. Currently it's 98.3%. And next year we're facing a fairly heavy rollover schedule for us. About 3.2% of our rents are rolling, but our team has been getting out in front of that and releasing it before the actual lease maturity. And we have a very strong team where they've handled over 2,500 lease rollovers over the course of the history of the company, and they're quite talented at that. So we've been experiencing good recapture rates on our lease rollover over the life of the company. That's been about 100%. And year to date this year, it's been 107%. And again, we think the quality of the portfolio will ensure that the occupancy remains high and the releasing rates remain favorable. Our occupancy has never been below 96%.
Obviously, the retail sector has been in the news quite a bit lately. Right. What are your thoughts on the state of retail real estate?
Well, the big news in retail real estate has been the impact that e-commerce retailers are having on brick and mortar retailers such as ourselves. And we believe our portfolio has fared very well, really on an absolute and relative basis to the pressures from e-commerce. And that's a function of the types of retail tenants we look for when we invest. We look for tenants that have a service, non-discretionary, or deep low price point orientation to their business. And that allows them to more effectively compete with e-commerce companies and also more effectively compete in a variety of economic cycles. And 80% of our portfolio is retail. Of that 80%, 92% of our tenants have one or more of those characteristics. And of the retail bankruptcies, about 22 that we've seen this year, 19 of those retail bankruptcies have not had any of the characteristics I just outlined. So we feel like our portfolio is well positioned relative to e-commerce.
Looking at your space in the market, what would you say is one of Realty Income's biggest competitive advantages?
Well, I think it's our access to attractively priced capital. And that allows us to focus on the highest quality net lease properties when we go out and acquire and create very attractive investment spreads that drive earnings growth. I think part of that is really a function of the strength of our balance sheet and, of course, our track record of growth. As I said earlier, we're expecting 6% AFFO per share growth this year. But on the balance sheet side, I think our investors derive a lot of comfort from the conservative nature of the balance sheet. We're financing the business with 2/3 equity, 1/3 long-term fixed rate debt. Year to date this year, we've raised $2 billion in permanent and long-term capital. $1.3 billion of that has been equity at favorable pricing. And the balance, $700 million, has been unsecured debt at a tenor of nearly 18 years, and that's also been done at attractive pricing. So at the end of the third quarter, we ended up with a fixed charge coverage ratio of 4.7 times, which is the highest it's ever been in our company's history, and a debt to EBITDA ratio of 5.2 times, very attractive level. So the balance sheet is in a very solid position, and very well positioned for continued growth.
John, thank you so much for joining us.
Great to be here, Matt. Appreciate you having me.
For more information about NAREIT's REIT world, be sure to visit NAREIT's website, REIT.com.